So today's Cardinal lesson, we're talking about IRMAA, which is the Medicare tax for 2026. And then we're going to have an emphasis on what you can do about it, which isn't a whole lot. But we're going to talk about it, and sometimes you do too much. Um, Now, Medicare, IRMAA stands for Income Related Monthly Adjustment Amount. I just love the government. They come out with these very descriptive names. There's no way, if you're reading all that, could you come up with that's a Medicare tax. But anyhow, it's taken on a life of its own. IRMAA, it's the amount, if you have a high income in retirement and you're on Medicare, you're going to pay extra, perhaps a lot extra, for your Medicare. So, with that being said, Tom, why are we doing this video today?
Yeah, I mean, we're doing this video because people hate surprises, right? I mean, they don't like them. And the one that we find people hate the most, the one that we're dealing with, at least in our world, is this IRMAA, this increased cost for Medicare. It comes as a surprise. They don't know what's happening. And they're just angry about it, right? And so what we want to do is sort of take the surprise out of it and teach you about it. Are there ways to plan around it and just put this in some context, right, as part of a larger plan? So let me bring up the show notes. These are at the link below our video. They're also on our website at cardinalguide.com. We have the board as always, and then we have a couple of different things. This chart gives you more the numbers related on the board too, but it gives you some idea of where these costs are. And then we actually have, this is the form, and we'll get into later in the show how to file this form. This is how you can appeal the IRMAA if you had a life-changing event. We'll talk about that more in a second. But we also have an example of a letter. We've redacted all personal information off this, but this is a real letter a client got from Medicare or Social Security about IRMAA. This is what it looks like when you get it. It really lays everything out pretty nicely, right? It tells you what your income was 2 years ago. We'll talk about that. It gives you what your premium is, what your extra cost is. So, I mean, it really does a pretty good job of explaining it. The problem is people know it's coming, and that's where people get upset. It's like they've done something 2 years ago. It's caused this extra cost. And again, it's a surprise, and people just don't like that. So we'll talk more about those forms here in a second. But let me turn it back to Hans, and we'll go through sort of the charts on the board here.
Okay, so income related monthly adjustment amount, IRMAA. And the first thing that's going on that I want to emphasize is right now in 2026, these are all the numbers with IRMAA, but they're going to use your 2024 tax return. So that's a real gotcha. If you have somebody that's turning 65 in 2026 and they are just signing up for Medicare, they're coming to us, they were born in 1961, they're getting ready to get retired or retiring, and now all of a sudden they're going to pay all this extra Medicare stuff, which is really a tax, a surtax, based upon something that happened 2 years ago. So then they get into and it's this funky thing called MAGI, which is modified adjusted gross income, or it's AGI modified. And it's 2 years ago. It's already happened. It's history. Yeah, there's nothing you can do about it other than possibly appeal. So this has a real gotcha effect to it with people. And then once people get angry about something, it's very difficult to use logic and make sound decisions. So we're just going to walk you through it. Not so much the why it's there, it's just what is and how it's calculated. So depending on how you filed your tax return in 2024, if you're married filing jointly, you're going to use this chart. If you filed as a single, you're going to use this chart. And in our example, this dude had $615,000 of modified adjusted gross income. And the modified is really just tax-free bonds. So if you own tax-free bonds and you're earning tax-free interest, they're going to add that to your income to calculate your IRMAA. So in any case, he had 615, which put him in this bracket, and he's paying $446.30 a month on all of 2026 for his Part B extra. So his Part B is going to cost $202.90, the same amount everybody pays, plus $446.30. And then for his Part D, his drug plan, $83.30 a month. Now that's not for the drug plan, that's extra for the drug plan. And Tom's going to go through that example in a little bit. But you find your place where your income in 2024, what bracket it puts you in, and you can see that a single person that makes a couple of $100,000 or 206 grand is going to fall in that same bracket that this guy fell in making 615. So this is very penal to single people. You want to pay attention to that. And so I want to push it to Tom, and Tom can talk a little bit about our examples down here.
Yeah, I mean, so in this example, we have a married couple, both in their mid 60s. Were working in 2024, but retired in 2025. That's an important piece that I'll come back to. But again, this is the example that was in the show notes, the letter there. So they made $615,000 of modified adjusted gross income. Again, Hans mentioned this, but I think it's important to just walk back over this again. And so the numbers they look at is, if you look at your 1040, your federal tax return, they're looking at two numbers: your adjusted gross income, and they add back in tax exempt interest. Those are the two numbers they look at to get to this modified adjusted gross income. If you have a bunch of municipal bonds, that's where that tax exempt interest comes back into play. So just know that. Some people think they can get around it by doing stuff like that, but no, that still comes back into play. But they had 615,000 in 2024, and they retired in 2025. So they get this letter saying, "Hey, you made over the thresholds in 2024. We're going to charge you more for Medicare." And this is really what causes people the frustration. Is one, they didn't know it was coming, and it's based off income from 2 years ago. Now, one point on that is it's always on a 2-year rolling basis. So come 2027, they'll look at 2025. Come 2028, they look at 2026. It's always 2 years. So if you had a spike in income 1 year and there's nothing to appeal, you might have to deal with IRMAA for 1 year, but it will go away if your income comes back down. So that some people get confused on that. But again, back to the example, 615, they're being charged an additional $446.30 for Part B, an additional $83.30 for Part D, as in drug. Those are additional costs. Everyone pays this $202.90 as the base premium for Medicare. And then in this particular example, their drug plan cost was $34.50. So that's a total of $767 per person, right? That's for each individual. Plus, they had a Medicare supplement. The Medicare supplement was $140. Again, in this example, your cost might be lower, might be higher. That depends on your age, depends on your location. But in this example, it was $140 for a G plan. So their total cost, all of Medicare, so Part B, Part D, Medicare supplement, was $907 per person. Or for a couple, that's a total of $1,814 total cost. About 40%-ish, somewhere, I haven't done the math exactly, but about 40% of that is IRMAA, that extra cost of the tax for Medicare. Now, in this example, really where the nice thing that came in is they retired in 2025, and their income is now much lower. They did some planning earlier. They got their income to be lower into the future. And now we're going to go back and file an appeal, right? So you're allowed to appeal this. You don't have to wait for it to catch up. You need a life-changing event, which is on the form in the show notes, and I'm going to show you how to file an appeal online. But some of the common life-changing events we use are work stoppage, work reduction. If there is a marriage or divorce, that's also a life-changing event. A death of a spouse is one. So those are some of the common ones that get used. But it allows you to say, hey, instead of using my income from 2 years ago, I want you to use my current year's projected income and then move that forward. One thing I want to caution people on, and I've seen this mistake happen a couple times, is people file the appeal. They had the life-changing event, they file the appeal, and then later in the year, they get this great idea to do Roth conversions, which might be a good idea, but we need to think about the impact on IRMAA. And so they do the Roth conversion, everything's going along smoothly. They get about a year and a half later, and they get a nice letter from Social Security saying, hey, by the way, you filed an appeal back in, I'll use the example for right now, you filed an appeal back in 2026, and you told us your income was going to be $210,000, for example. And in reality, your income was $300,000. Therefore, we should have been charging you more, and we're going to go back and charge you what we should have done. So when you file the appeal, you need to have your income be accurately projected, right? You can't file an appeal, get it approved, and then have higher income. They will come back and ask for that back. So I caution people, because I've seen people file the appeal. It's going to get approved if you're projecting your income from this year, because they don't know any better. They're just taking your word from it. But they do go back and back check it when they get your tax return for that year you filed the appeal for. If it's different than what you told them, they will come back and ask for that difference there. So a word of caution there. But let me bring up I'm going to show you online this appeal. Let me walk you through how it works. And this is something they opened up somewhat recently, sometime in 2025. They allowed you to file an appeal online, which is great. It simplifies it a lot. When I first started, I was having people go in person to bring the form to Social Security, which was a nightmare. Then they added a fax option, which was slightly better, but then you never know where it went. Now you can do it online, which is a much better way to do this. So if you log into your Social Security account, I'm logged into mine. Obviously, I'm not Medicare age, but again, it still works. So you log in there. This is the home screen of ssa.gov. Sign into your account. There's a button here, Upload Documents. So you click on that, and it takes you to a screen where it gives you a privacy statement or whatever there. It verifies some of your information. So you hit next. Now we get to this where you want to document type. It's SSA form is what we're wanting to upload here. You hit next, and then you're going to upload. It gives you a drop down of forms. They're in alphabetical in the numerical order. So SSA, we're looking for 44. SSA 44 is the form number to file the appeal. So you click on that, hit next. Complete online. This is the new thing we can do. Hit next there, and it takes you to the form. So it brings in all the charts. It brings in all the stuff, kind of what that letter was in the appeal form that we have in the show notes. It's right here online. You go through the life-changing event. Again, then if I was filing an appeal, if it was me in the example, we would do work stoppage, their life-changing event. I retired January 1st, 2026. Again, put whatever date you retired there. Actually, it's only month and year. They don't need the day. January 1st, 2026. Tax year, that happened in 2026. And this is where you start estimating your income. So let's say my estimated adjusted gross income was going to be 200,000, for example, and I had tax exempt interest of 10,000. So that would put the modified adjusted gross income at 210,000, and then we do the married filing jointly there. So again, you fill out the form. They do want you to upload some documentation here later on. So when you're going through that, if you have questions, you can call us and let us know. But it's pretty straightforward. Fill in the form, submit it, and then it will get processed. Social Security will process it there. When it's done properly, I mean, the success rate is 100% when the form is filled out right. I mean, I can't think of it as a situation where we've had someone actually had a life-changing event and their income was actually lower, not get this approved. So what's nice about that is you can do some planning. We'll get back to the board here and we can talk about sort of planning options here. But again, if you have a life-changing event, which is listed in the show notes and it's listed on that form, and your income is going to be less than it was in the year they're doing it, maybe you don't even get rid of IRMAA completely, but if you go down a couple brackets, that's going to save you money. So certainly worth filing the appeal if you had the life-changing event and your income is going to be less in that year. Let me turn it back to Hans, and we're going to go through sort of the planning considerations we have here on the board.
Okay, I understand. This goes on every year. So like you're going to filing your 2025 tax return right now in this season, early 2026. And then by the time November of this year rolls around, if you're already on Medicare, they're going to look at your 2025 tax return and they're going to set your IRMAA for 2027. And you're going to get a letter just like the one in the show. You're going to get that during November of 2026. And these numbers will be adjusted upward slightly. And this goes on every year. So a lot of the mistake is some people think that this gets set when you first go on Medicare and you're in this bracket forever. No, they're going to be looking backwards 2 years on and on and on and on and on. And even if this couple is successful with this appeal, they're going to also, if they filed their 2025 tax return, which they're going to be filing here in the next few months, they're going to be subject to this IRMAA for 2027, and they're going to have to reappeal it if it's another high amount. So this is something that's going to go on through all of your retirement, unless your income as a couple gets below 218 grand, or as a single person, it's below 109 grand. If you have a year like that, then you won't get any IRMAA letter. You'll just be paying the standard rate. So we want to talk about the planning considerations. I'll take the first one. Is there's a 2-year look back. So it's 2026. The income that we're earning and doing right now is going to determine 2028's IRMAA. So, Tom?
Oh yeah, one thing on that makes it a little bit tricky from a planning perspective is we don't yet know what 2028 IRMAA brackets are, right? This 218 number we have is the 2026 IRMAA brackets, but that's based off your income from 2024. So when we're making decisions in 2026, that's going to impact our 2028 IRMAA. We don't know what the brackets are. I guess we could guess at it. We could assume some rate of growth on that because they do typically go up every year. But that would just be a guess, right? We don't know. So what I typically advise is use the bracket that you know, which is we know it's 218. If you keep it, if we're trying to plan around this, which is again, whether you should or shouldn't is a different question. But if you are and you want to stay below IRMAA, use the 218 number because we know it's there. You're going to have some automatic buffer built in because it will be higher 2 years from now. But because we don't know how much higher, it's probably not worth risking it because if you go $1 over this bracket, you're in the next IRMAA level. So it's a cliff. You go $1 into that bracket, you're paying it. So again, be a little bit cautious there. I've had some people try to project it 2 years from now, and they might get it, but they might not. If you wait to the end of the year, right, by the end of 2026, they will probably have released 2027 IRMAA rates. So you can play a little bit of games where you get a little bit extra, like Roth conversions, for example. You could use the 2027 one because 2028 will be higher, but something just to keep in mind there. Number 2 on the planning considerations, the RMD effect. So there are a lot of people, once they learn about this IRMAA, they know it exists, which is I think that's a great first step because when we first started talking about this, a lot of people had no idea what it was. Now, more of our clients that are coming in that have watched maybe several YouTube videos at least know about it. They've heard it. We've talked about it. They've learned it, which is good. I think that we've made progress there. And now their goal, they come in, and this is where they can make mistakes. Now their goal is to avoid it at all costs. I don't want to pay that. I don't want to do Roth conversions, or I don't want to take money out that's going to push me into that, which might be the appropriate level, and it might not be. And this is where this RMD effect comes into play, is when you turn either 73 or 75, depending on your age, the IRS says you have to start taking money out of your IRAs and your 401ks. Well, when we start doing planning, we start looking to see what is that, again, projecting some growth in those accounts. What does that do to your taxable income? Right? That might push you into higher IRMAA brackets down the road, again, depending on the size of your IRA. And if that's the case, we don't want to be short-sighted and not do any IRMAA now, right? If we avoid all IRMAA now, we might be making the IRMAA problem worse down the road. And make that even worse on top of that is if it's a couple and the first one dies. Now we've delayed this problem out to the future. The first spouse passes, and now the IRMAA brackets, if we look at this chart over on the left side, they're essentially, you get there twice as fast, right? It's 109 for a single versus 218 for a married couple, right? So it's much more costly for a single tax filer than a married couple. So again, it can be short-sighted. We want to look at the RMDs. Is that going to push you into IRMAA brackets down the road? And if it's so, then you have an IRMAA problem. It's just, is it now or is it later? And sometimes it's smart to pay some level of IRMAA now to avoid higher levels later. Again, built out as part of a larger plan, not a recommendation, a blanket statement. It needs to be specific to your plan. But again, I've seen a lot of people come in that they've learned about it. Now they're doing everything they can to avoid it now. And it's short-sighted because they're going to be paying it later anyways. Hans?
Yeah. So like number 3 here, what can we do about this? Well, if we're doing planning for people in their 60s and maybe they already have a lot of money in their Roth, or we're going to be adding to it, doing Roth conversion, letting them grow in the Roth, when they get down the road, they can start pulling out income out of the Roth. Let's say they are a couple and they're having to live off of this IRA and other taxable income. They can pull out income out of their Roth, and not only is it tax-free, it doesn't affect IRMAA, so they can get themselves down under whatever threshold they're going for. And then there's Roth annuity income, which is planning where you're going to put money in a lump. It's in a Roth, or you're going to convert it into a Roth so that by the time you start the income, you're getting a monthly check for life or the life of two people, and that's tax free. So it's not driving IRMAA, or it's not driving MAGI, the modified adjusted gross income. There's life insurance withdrawals; those can be made tax free. So there's ways to create tax free income to the extent that you're going to want to stay below these IRMAA thresholds. Tom?
Yeah, I mean, I think those are all good planning strategies. Number four, Roth conversions cause IRMA for 1 year. So again, when you do a Roth conversion, you are increasing your taxable income in the year you do the Roth conversion, right? If I convert $100,000, my income is higher by $100,000 in that year. A consequence of that is 2 years later, that could push me into IRMA brackets, right? I mean, that could have pushed us into the levels where we're paying more for Medicare, but it's a 1 year issue, right? If we don't do Roth conversions next year, then 2 years after that, 2029, is that right? 2029 wouldn't have any IRMA cost, right? So it's a 1 year spike that could cause IRMA. Versus if we're not doing Roth conversions and we're just waiting to RMDs hit, and those accounts continue to grow and they continue to grow. Well, now we might have high RMDs that cause IRMAs for the rest of our life, right? Because now we have to take that money out. So again, Roth conversions certainly cause potentially higher IRMA, again, depending on how much you do and all of those things. But it's a 1 year issue. Now, if you do it a couple of years, then we're talking about 2-3 years. But once the Roth conversions stop, then we wait a couple of years, the IRMA impact goes away. And so it's something to consider. And again, when we build out a larger plan, we're taking into account all of these factors, right? If we're doing Roth conversions, we want to see the impact, one, on your lifetime taxes owed, and can we reduce that? But also the increased cost of the IRMA, because that's another type of tax. And again, we're weighing all these against each other, really trying to get to the optimal strategy for your plan, which is different from person to person. So again, that's something to consider. Hans?
Yeah. So for those of you qualified charitable distributions, QCDs, we have other videos on these, but it's just basically taking money out of your IRA and donating it to a charity. And don't try this at home. You need to consult a professional. If you mess this up, you'll end up paying taxes on the money. But you can give away over $100,000 in a year through a QCD to a qualified charity, and that counts as your RMD, required minimum distribution. Now, I'm not suggesting you all go out and give away 100,000 of your IRA. Just saying there's a cap. It's over 100,000. But what you could do is once you get in this RMD situation, you're already there. You've got quite a large RMD that's pushing you into higher brackets, and you're triggering IRMA and higher taxes. You could take some of that RMD for 2026 and beyond. You could turn it into a qualified charitable distribution, a QCD, and then that's not going to count as taxable income or MAGI. So it's going to lower your threshold. So that QCDs are a tool that we can use, providing you want to give money to charity. It doesn't make sense to just give money away just for the tax benefit. You want to have charitable intent. Once you have that, we can use that to lower your tax bill. Tom?
Yeah, QCDs are wonderful. The only downside is you have to be 70 and a half. But once you're there, it's a great tool, a way to lower your taxes. Again, if you're charitably inclined, it lowers your RMDs, it lowers your taxes, potentially removing any IRMA issues there. So again, it's a wonderful, wonderful tool to use. Number 6 is sale of a home for a high value. So, if we think about what's happened in the real estate market, really across the country over the last several years, is values have gone up pretty significantly, right? I mean, they're starting to soften a little bit now, but at the end of the day, if you sell your home as a married couple, you can exclude up to $500,000 of capital gains. For a single tax filer, that's $250,000, which again, most people can fall within that. But you start living in areas where maybe you've had your house for a long time, or you're out in California or New York or somewhere where we had really high value appreciation in the homes. This causes issues, right? So if I sold my home and I'm married and I had 750,000 of gains, my purchase price plus improvements And minus that from the sale price. If that difference is 750,000, I can exclude 500 of that, but 250 of that is capital gains, which adds to your modified adjusted gross income, which then possibly increases the IRMAA cost. And again, this is if people aren't expecting this, and there's really not much you can do about it if you sell your home. Now, if you line that up with a life-changing event, we can maybe appeal it using one of the other life-changing events, but selling a home in and of itself does not qualify as an appealable action. But let's say you do that in a year you retire. Now we're talking. Now we could use the retirement as the window to appeal this. We had a client, and it wasn't their primary residence, but it was a rental property, right? They sold their rental property 2 years ago, and they were retiring, and that's when they met us, kind of right starting Medicare. They sold their home 2 years ago. They didn't know this was coming, and they get this letter. We sign them up. They didn't really tell us about the sale initially, and then they get this letter. Hey, what is this? It's like, oh, that was because of the sale 2 years ago. We were able to help them appeal because they had that life-changing event of retirement. That's what we were appealing, not this house sale, but really what caused the spike in the income was the house sale, but they also had less income because of retiring too. So we sort of worked it out where the appeal went through, got approved, didn't have to pay it. But you need to be careful when you start selling, capital assets. This could be highly appreciated stock. This could be property, it could be rental properties, anything like that could cause IRMAA concerns there. So just be mindful if you start selling things that there is possibly an impact depending on the value of how it impacts Medicare. So again, all of these are intertwined. That's why when we talk about this, we talk about doing sort of a comprehensive plan where we look at everything, because you start making decisions in one area, it impacts a lot of these other areas, and you need to make sure that they're all coordinated together. And that doesn't always mean avoiding IRMAA at all costs, right? I think that's a big mistake we see. Sometimes it's okay to pay some level of IRMAA. I just want you to do it intentionally. I want you to know it's coming, be okay with it, not be surprised by it, and then we move forward from there. So Hans, I don't know if you have any follow-up thoughts there.
Well, in terms of comprehensive financial planning, IRMAA touches all the other 7 areas. IRMAA comes under Medicare, but it's a surtax. It's another type of tax, so it's going to affect your taxes. It's also driven by your taxable income or your adjusted gross income or MAGI. It doesn't really have much effect on the estate plan, other than the widow's tax and being, one of the two of you being pushed into that single taxpayer. It has everything to do with your income. It's one of the words in income. It's income related. High income people pay IRMAA. Your IRA 401k is affected because that's where the taxable income comes out of, or if you're doing Roth conversions, that causes shoot ups in income. We haven't really talked much about long-term care. And then Social Security. Social Security is going to be taxed in the same way that IRMAA, that Medicare is going to be taxed or in higher premiums. It comes from the same place. So I want to bring Tom back on. I'm Hans Scheil.
And I'm Tom Griffith.
And we thank you very much for listening.
Thank you.